Welcome back, D-traders. Wall Street looks like an airport where everyone is checking their schedule of flights not to miss the right plane. This trading week is loaded with important reports and events, inflation data, developments in the energy standoff, GDP reports. As usual, everything will be flared with the fears and risks. The benchmark US stock indexes gyrated last week. After a seesaw, Wall Street indexes closed mixed with the minor changes. The Dow Jones shed 0.15%, the Nasdaq edged up 0.12%, and the S&P500 closed 0.08% down. The minor changes prove resilience on Wall Street. The top indexes opened on a pessimistic note on Monday. The S&P is expected to trade in the corridor between 3,800 and 3,900 points today. The Nasdaq closed with gains for 5 weeks in a row. Nevertheless, the sluggish dynamics looks like drifting. The red-hot non-farm payrolls released on Friday did not clear up market sentiment. The U.S. economy added 372,000 jobs last month, higher than expected. The employment growth is similar to the pre-pandemic rates. On the one hand, robust hiring accompanied by growth in wages confirms that the U.S. economy is still far from recession. This is great news for stocks. On the other hand, strong employment encourages the Federal Reserve to push ahead with its measures against inflation. What exactly scared investors worse? We will see in the nearest days. Investors will get to know inflation data. Analysts do not foresee any signs of its deceleration because gasoline prices, food prices, and airfares remain high. The consensus suggests that the CPI will jump to 8.8% on year. The core CPI is expected to inch down to 5.8%. And today the economic calendar is empty, and the only catalyst could be a speech by Fed policymaker Charles Evans. The companies with a mega capitalization are trading mostly in the red in the New York pre-market, except Tesla shares that gained 0.9% in light of the news on Elon Musk's decision to cancel the Twitter takeover deal worth $44 billion. Today, Twitter threatens to file a lawsuit. Twitter stock lost 6.9% in the pre-market. Financial companies included in the S&P 500 will open the season of quarterly reports on Tuesday. Large U.S. banks such as JP Morgan, Wells Fargo, Morgan Stanley, BlackRock and the Citigroup are due to report on their results for the second quarter. The U.S. dollar is ruling the currency market. The greenback is held in the upper hand of major currencies with its index standing at 108.10. Extending its stunning rally, the index is likely to trade in the intraday corridor between 107.40 and 108.50. The upper border seems incredible. The level of 108 was last seen in October 2002. The dollar's rally sparks memories of historic peaks at 120 points reached 20 years ago. Analysts warn that a technical retracement will follow. Anyway, solid data on the U.S. economy and the Fed's hawkish monetary policy on the front foot compared to other central banks. Europe is overwhelmed by recession fears and the simmering energy crisis, which pushed the euro almost to the parity level with the US dollar. At the moment of recording this video, the euro was trading 1.0006 pips above the parity level at 1.0003. The Canadian dollar also has fallen prey of the king US dollar. The USD CAD pair again climbed above 1.30, heading upwards. Amid the fundamental picture, the intraday corridor for the currency pair is defined between 1.2980 and 1.3060. While the US labor market revealed robust employment, the situation in Canada is much worse. The Canadian economy lost 43,200 jobs in June, defying expectations for an increase of 23,500 jobs. It's the first contraction since January. The loonie could find support from the Bank of Canada that is widely expected to raise the key interest rate by 75 basis points this week. Until then, the Canadian dollar looks weak due to developments in the oil market. The turmoil in the energy market was triggered by Russia's move to cut off gas flow to some parts of Europe via the Nord Stream first pipeline. The official reason is scheduled maintenance for 10 days. Currently, the pipeline is operating at 40% of its full capacity. Analysts express fears that Moscow could terminate its gas supplies indefinitely, which will deal a blow to the European economy. The fact that Moscow is reducing its gas exports has already forced Germany's Uniper to apply to the government. The energy standoff magnifies the likelihood of a recession in the EU countries and drags down oil prices. WTI fell 1.73%. and Brent crude shed 1.54% to trade at $105.38 a barrel. As for the crypto market, Bitcoin's jump was followed by a slump of 6.25%. The token closed below $21,200 on Friday and slipped back to $20,500. The bulls defined this level, though without much success. Follow developments in financial markets on InstaForex TV channel. See you tomorrow.